Results today, you have Adani Ports, Motherson, Sumi, important ones to watch out for. But let's shift gears and get you some updates on the COVID front as well. India has added 12 lakh new cases in less than a month. Karnataka CM, meanwhile, has recovered from COVID-19. No timeline in place to reopen schools yet, says the government. Maharashtra, meanwhile, looking to increase, or rather should be increasing COVID testing. Word coming in from former CM Fadnavis. COVID impact to persist on retail and aviation, flags of ICRA. Key government meet on vaccine procurement tomorrow, so all eyes on that. BMC commences second phase of Sero survey in Mumbai. WHO chief calls for increase in funds to combat the virus. Zydus is hopeful of a vaccine by March next year. And lastly, you have China reporting 44 new COVID cases.
Okay, thanks for that, Karanya. From COVID, let's switch back to the markets for a second, and let's just get you guys up to speed with what the broader movements are, which indexes are moving, and which select stocks are moving. So currently, the Nifty is perched 0.6% higher, 69 points, at 11,339. The midcap index is up 0.3% at 4,490. The auto index is up 0.16%. Around 7,633, and the bank index is really shining today on the back of all that fundraising news, up nearly 1% or 193 points at 22,000. Select stocks in focus will obviously be Axis, ICICI from the banking pack. Apart from that, you have a lot of metals creeping in, which I'm going to talk about next. You have a JSW Steel, a Tata Steel both in there this morning for reasons that metals are in focus. On the losing side, like we just spoke about, you have Titan really dragging today on the back of those numbers. You have a Shree Cement, which had good numbers and good profitability, but weak stock price reaction. So maybe the earnings weren't quite up to the estimates that the analysts had in mind. Dr. Reddys and Cipla also cooling off today slightly post the large moves that we saw in those yesterday. So that's how the market's really shaping up. The breadth seems to be in favor, 35 advancing in terms of 15 declining in terms of the Nifty. So that was a quick little market check for you. Let's now just quickly address what's happening with metals. This morning, Akul Suri on the channel came and said that metals could be the trade of the month. If you're looking to make quick money in the markets, metal might be the place you should be looking. Now, just to give you some positive data points as to why he's flagging that off, it's been the 8th straight day in a row that the metal index has gained, and select metal stocks as well. This is not a regular phenomena. It's definitely an anomaly. It's the longest winning streak since 12th of September 2017. They're up 10% in the last 5 days and 15% in the last 30 days. 18% away from a 52-week high and 62% above the March low. So there seems to be something going on. It's just not a regular movement. It's something definitely out of the ordinary. And if you want to know stocks here that are outperforming, so stocks that are up over 20% month to date are a Zinc and a Welspun Corp. Over 15% month to date are a SAIL, Tata Steel, JSW Steel and APL Apollo. And then over 10% at least, you even have a JSPL, Hindalco, Hindustan Copper, and an NMDC. So across the board, a lot of action. You should look at where you can get in on that.
Right, let's shift gears and talk about an NBFC. We have the management as well joining in shortly to talk about how Equitas' Q1 panned out. A moratorium has moved 90% to 50% now at 43%. NII has also seen a decent 20% growth on a year-on-year basis, coming in at a little over 404 crores. Let's chat more with the management. Mr. P.N. Vasudevan, the MD and CEO, joins us right now to take us through the numbers and the way forward. Mr. Vasudevan, thank you so much for taking time out. Moratorium levels have come down to 43%, perhaps the best highlight that we've seen in your Q1 financials. How have they progressed this quarter? If you could shed some light on the trajectory and any other items which were noteworthy during Q1 that you'd like to highlight for us.
There is a lot of difference in our customer segment compared to maybe the bigger banks. There are about 5 points which are very different from our customer segment compared to the other banks. One is that practically to most of our customers, we are the sole bankers. That's a big difference. Second thing is that we don't employ DSAs to source our customers across our product lines. So we mostly get our customers through customer referrals and then through direct sourcing. So which means that our understanding of our customer is much stronger than when you source them through an intermediary. Third is that almost all our customers, they are into small businesses which are into daily use products and services. So the kind of products and services they deal with are daily use. They are not discretionary spending. They are not luxury spending. So as and when lockdowns get opened up and as and when life comes back to some level of normalcy, our customers' businesses should come back quite fast because they basically supply products and services which are of daily use requirements. Fourth is that nearly 90% of our borrowers are from the informal economy. And fifth and the most important point is our ticket size. Our ticket size is actually, if I include my microfinance borrowers, my average ticket size or lending size is only 65,000 rupees. And if I exclude my microfinance customers, even then my average lending per customer is just about 4 lakh rupees. So we are basically into very small level of lending to a very large number of borrowers, widely dispersed credit risk, and people who are in the informal economy and doing daily use products and services. So that is why you see when there is a lockdown, our moratorium is high because when they can't open their shop, there is no way that they can pay us EMIs either. But as and when they are able to open up their shop and get back to some business level of activity, then their ability to come back should be also strong, which you have seen, 90% in May to 51% in June. We could see a dramatic drop, basically because life was beginning to open up. So that's on our moratorium. We had also nearly 1,000 crores of loans which were in overdue as of end February. Out of that, nearly about 87% of the customers have paid either their full installments or at least one or more installments. So that leaves only about maybe 12-13% of the customers who are overdue as of February end, who have yet not paid. So that will be something that we are still under follow-up.
All right, so great to know that the moratorium numbers have come down significantly. But what stood out to me from this quarter's result is that the deposit franchise has grown 30% YOY. That's even higher than the larger private banks, and they're the ones who are supposed to be benefiting on the deposit train right now. So firstly, how have you achieved that, or what's contributing to that? And secondly, the profits have held up pretty fine, although your provisions have accelerated. So what's the reason for that?
Yeah. So in terms of the other parts of the bank, our deposits have done really well in the first quarter. We went very strong on the digital. So during the month of April, May, when there was a practically complete lockdown, we were very active on our digital marketing, and we have our selfie savings account where customers can open an account within 4 or 5 minutes online by themselves. So we actually opened about 55,000 accounts in the first quarter. Against our normal run rate of around 30,000 per quarter pre-COVID. So we actually nearly doubled the number of accounts that we opened in the first quarter. And we were one of the very early banks to launch the video KYC, which helps us to complete the full KYC and convert it into a regular account without having to meet the customer. So I think we are the 6th, 7th bank in the country or whatever, one of the definitely early banks to launch the video KYC. And in terms of our advances, yes, we started lending from May. But June, we did about 450 crores of lending, which is nearly about 42-43% of our normal levels of lending. And July, of course, we have seen again a further increase in our lending. Basically, the demand is very high. The demand for loan continues to be very strong because the segment which we serve, the unmet demand, unmet credit demand from the segment that we serve is very, very large, very large. So there's always a demand. So there's no dearth of demand. It's only that we have to be very careful and choosy in terms of how we do our credit filters before we give a loan. So generally, the first quarter has been comfortable in other factors. We also put aside 45 crores of COVID general provision in the first quarter. We had 100 crores of COVID provision done in the month of March. We added.
Can you also tell us what were the triggers for your good operating profits despite a low fee income and the slowdown in credit growth for Q1?
So in terms of our pre-provision operating profit, the performance is largely triggered by the fact that our advances, has kind of remained at the same level as March, more or less. It's remained at the same level as of March. So obviously that is one big factor from an income perspective. Second thing is that our fee income has dropped, but because of very little disbursement in the month of April and May, obviously the fee income has dropped because of that. But our other fee income in terms of our distribution of insurance products, etc., that has actually done well. We had our all-time high fee income of distribution in the first quarter, so that also helped a bit. And finally, I think lastly, the point is that the operating expense has also come down compared to the fourth quarter. The operating expense has come down, and that's also another contributory factor to the pre-provisioning profit, going up.
All right. And so specifically on the customer segment that are the daily use product and services customers, are they faring better than the retail borrowers? And how resilient do you feel microfinance borrowers are to the economic downturn as opposed to, let's say, traditional retail or corporate borrowers?
Yeah, so as I mentioned, most of our customers are into daily use product and service businesses. So their ability to come back is generally strong. And we have seen this. We have seen this in the past when, we had demonetization, we had GST, we had a lot of natural calamities in the forms of floods and cyclones, etc., in different parts of the country. So we always have to go through a certain period of, supporting and working with our clients. For 2 months, 3 months, they're just not in a position to pay because of those kind of disturbances to their life and business. But we have always seen that, once the life comes back to some level of normalcy, they tend to come back and pay. And we have really never seen an issue, after, at the end of any of those kind of, natural calamities and all that. So this time also there has been a very strong disturbance, really strong disturbance, and the impact has been felt. I mean, we have 43% of our book under moratorium in July, so obviously the impact has been felt. But once the moratorium comes to an end in August, from September, customers will have to start paying up. And but by September, we also hope that the level of lockdowns will continue to keep getting eased up in different parts of the country, which will help our customers to come back.
Okay, Mr. Vasudevan, thank you so much for highlighting all the key triggers and key steps to be taken going forward as well, the trends expected going forward as well. Equitas Holdings, meantime, continues to trade weak. The stock is down a little over 3% at the moment. Okay, let's touch base with our market guests. We have Kunal Bothra on the technicals, Ashish Maheshwari on the fundamentals. Morning, gentlemen. Kunal, coming to you first for your trading calls.
So, good morning, Karunya. I'll suggest a couple of buy calls, and I think the focus is now on stocks which are relatively low beta. So, I've picked up two names particularly which are typically defensives or low beta. The first one is about TCS. I think the stock looks poised for yet another round of breakout on the upside. TCS has been a big underperformer since I think the last couple of weeks, and especially on the back of that big run which you've seen for Infosys and many of these other large cap IT names. And I believe that this underperformance could get caught up into for TCS. Hence, would suggest a buy with a target of 2,400. Stop loss could be kept at 2,250 levels. The second would be ban HUL or Hindustan Unilever. And even this stock is now trying to come out of almost a 1.5 month of consolidation. I think the entire month of July, the stock had consolidated at this 2,200 mark, 2,200, 2,220 kind of levels. And now it seems like with more of the FMCG stocks could probably give a kind of a short-term breakout of this rounding bottom pattern as well. So I think HUL could be a top candidate in that regards of a potential breakout on the upside. Would suggest a buy with 2,300 as a target and stop us at 2,180.
Okay, thanks for that, Kunal. Ashish, good morning. What about you? What's looking good to you today?
Yes, couple of mid-cap ideas which I like to share with your viewers today. First is Polyplex Limited. This is a company which is into packaging and among the top 5 producers of PET films in the world. And they are known for their lot of innovativeness in PET films. So the kind of thin BO PET now they are making, it's finding a lot of applications into your mobile phones to TVs to solar panels, etc. So I'm expecting very good result from this company on 14th of August this time. And this year, last year they did in fact a EPS of 88 rupees, which I'm expecting in next couple of quarters only they are going to do that. So stock is all set for getting re-rated in packaging industry because of very high demand which they are getting from their user countries, because they sell their products to almost 80 plus countries. So this is a stock to watch where a lot of value is still there. My next pick is Shilpa Medicare Limited. This is again a pharma company which came out with flying set of numbers. If you have seen their Q1 numbers, net profit was almost 430% up. Margins were almost 1200% improvement was there in EBITDA margin. And again, their USPs are API, and API is something which is catching a lot of attention nowadays because there's a lot of demand which has suddenly come up in API segment. Again, USPs of this company is their innovations in oncology segment, from where a lot of buying is coming. As far as their patent, if we talk about, they are having almost they have filed almost 380 patents, and out of that, 319 patents are still to get registered. So what I can see is the next 1 or 2 years they are going to get a lot of new molecules and patents. So this is again a stock to watch. Though stock has seen some run up post their quarterly numbers, but I'm very bullish on Shilpa Medicare, and in my view, next 1 year 800 and in next 2 years you may see double from here.
Okay, so interesting picks coming in from both of our experts. On the trading side, you have 2 large caps, HUL and TCS. And on the wealth creation for the long haul, we have 2 mid-cap names coming from Ashish Maheshwari, Polyplex and Shilpa Medicare. Moving on to some viewer queries then. It's an email from Rajesh Shah, is based in Bhopal. He wants to invest in Tata Consumer at the current market price. So how does it look from the long haul perspective? Kunal, the stock has seen a solid run up. If you look at the March lows, the stock has more than doubled. Even the last 1 month has been quite buoyant and quite upbeat for the stock. Should one look at investing it at these 515, 516 levels, or should they wait for some dip and then enter?
Invest into the stock irrespective of the kind of price levels. It can be maybe 40-50 rupees lower as well if the market goes through one more round of short-term correction or some sort of a mean reversion. It could happen that many of these stocks which have run up significantly higher, you can come back to some sort of a moderate kind of a support zone. So I don't deny that. But then when you're looking to buy stocks, you're looking to see the strength and the solidity of the stocks. And Tata Consumer or erstwhile Tata Global have shown the kind of trends in last 4-5 months. So I remember clearly that the stock at one point had gone back below the 300 mark in the Feb and March correction, and post that it's given a very strong and solid kind of a bounce back. It's almost a V-shaped recovery. The stock has already shown such kind of recoveries in its historical charts as well, and whenever the stock has done that, it's given very strong and solid returns even post those kind of levels. So I think the long-term charts are extremely attractive for Tata Consumers, but it's just that since you've missed out on the stock, in terms of buying, you could probably look to buy now and buy it in stages. Maybe if the stock gives you a 10% correction, look to buy back or add further, and maybe the stock comes back to that 400 mark. I think that's where you should be fully deployed in terms of your expected allocation, which you're looking to deploy on Tata Consumer.
Okay, so Kunal seems fairly upbeat on Tata Consumer, and he has been for a while. I can vouch for that. Ashish, what do you make of Tata Consumer? I mean, it's got a great management, great business, and they seem to be gearing up to become a big consumer play. Do you see the story playing out as you anticipated?
Yes, in fact, this is going to be a multi-bagger stock idea even from here. Again, the rationale is if you see their Q1 numbers, in fact, all the segments they are showing double-digit growth, which is a dream kind of growth for FMCG companies. And again, the shift which is happening now in consumption pattern, that people are shifting from unbranded product to branded products, and therefore into spices and pulses, etc., will keep on giving them volumes. Another positive thing is this is a global company. There's no more only Indian companies, so they have very decent presence in US. So there also we have seen because most of the people were there in home, and further also in coming months also not too much outing is expected. So a lot of consumption is picking up as far as FMCG companies are concerned. So Tata Consumer is going to be a very major beneficiary. The last quarter numbers, margins were also very good margins they have demonstrated. And in my view, if investor can hold this stock for 1 year, he may expect 650 to 700 also. So ideal time to buy Tata Consumer is into a staggered manner. So you buy at 520, you buy at 500, but don't miss the stock in your portfolio in my view.
That Ashish is just as positive on Tata Consumer as Kunal, and with that you have a consensus view coming in from both our experts. I'd say it's safe to move to the next query now. And we have Ajanta Singh, writing to us from Delhi. Bought 50 shares of Bajaj Auto at 2,333. Please share short-term to medium-term view. So Kunal, how's that short to medium-term chart looking?
Well, it looks quite okay. In fact, many of these auto stocks are going through a strong cyclical kind of an up move. I think in the last 2-3 months, and especially the last month, many of these auto stocks have picked up, good pace on the upside, and I think which is where a lot of these auto stocks have managed to garner more trader and investor focus. There is a short-term hurdle or a resistance at 3,100 for Bajaj Auto, and what's a bit concerning, for the stock is that the volumes have started to dissipate, or volumes have started to ebb off. When the stock is consolidating, which is natural as such as well. So you need to, if you've already held on to Bajaj Auto for, from much lower levels of 2,300, then you have a lot of cushion, for you to hold on to the stock from a longer term view, because if the stock manages to recover then and break out above the 3,100 mark, then I believe that it should dash back towards the all-time high, which I think, if I'm not wrong, is at 3,300 approximately for Bajaj Auto. So if you can hold on to the investments, it would be much better. In terms of trailing stop losses, you can have a 2,900 approximately as a trailing stop loss. Keep that as a trailing stop loss and hold on. As I said, if 3,100 gets taken out, then the stock should be inching back towards its all-time high.
Ashish, what are your views on Bajaj Auto, especially from the medium to short term? Because right now there's still a lot of uncertainty, a lot of pain as far as demand is concerned. Yes, two-wheelers are reviving, but what about exports? The management said exports, especially three-wheeler segment, will continue to weigh in for quite some time. So given the circumstances, near to medium term, what's your view?
Even July sales number year over year fall is just now 10% minus. So this shows that a lot of people are now buying two-wheelers, three-wheelers, etc. once again, because now people are shying away from taking the public vehicle because of COVID situation. So companies like Bajaj Auto, where they have very recent distribution network, they tend to gain out of this change in habit of commuting per se. So this is the reason from down, we have seen the stock touching to almost 1,800 rupees in lockdown time, and there's a vertical rise in the stock to almost 3,000 rupees. So my view is that if we have to take a call on automobile sector, you have anyway very limited stocks, and Bajaj Auto being again a market leader in multiple segments, like there are not too many choices but to pick this stock. Again, I'm bullish that going forward, exports will also pick up. Their last quarter EBITDA margins were quite surprising. They have shown improvement. And Another thing is the cost-saving measures what companies are taking now will also contribute to the bottom line. So my suggestion will be to remain invested in Bajaj Auto. I'm expecting 3,300 kind of levels in next 6 months here.
All right. Thank you so much, both of you, Kunal and Ashish, for helping our viewers out and for sharing your own ideas to invest and to trade in. With that, slipping into a break, we have more management chats lined up when we come back and, of course, market-related updates.
Hello and welcome back to Buy Now, Sell Now. We're now joined by a very special management. We have Anand Agarwal, who's the CFO of V-Mart with us. Good morning, sir. Welcome to the show and thank you for taking out the time to chat with us this morning. You know, we'd like to know, given that the unlock momentum is now gathering a lot of movement rather, specifically over the last 1 to 2 months, are the stores now operating uninterrupted? And how are the volumes and sales that you're witnessing pre-COVID versus now?
Hi, good morning. No, I would not say that, it's uninterrupted. We are still seeing a lot of areas and, in fact, some states in particular having extended lockdown periods. If I look at Bihar has been in a state of lockdown since 16th of July. And it's already announced to continue till 15th of August. Similarly, in UP, which is also a very, very big market for us, almost 45% of our revenues coming in from UP, we see weekends, 2 days of the week getting shut down, which traditionally are the largest, footfall days traditionally for any retailer. And likewise, you have parts of Madhya Pradesh, parts of Orissa, parts of West Bengal, and also parts of Assam, where we see, a couple of days in a week where we see lockdowns. So therefore, on an average, what we see is that during weekdays, almost 60 to 70% stores are, getting operational. And during weekends, actually that count comes down to almost 20 to 30%. So it is still, a state of a slight uncertainty, if I were to say, and but we still remain very optimistic because what we are seeing is that whenever these stores are opened and whenever we are able to operate, we see good amount of footfalls, we see good amount of sales happening on that particular day.
Okay. At a time like this, of course, your numbers have reflected a lot of weakness owing to the COVID-led disruption. Talk to us about how you're optimizing costs, especially given the fact that a large part of your costs are fixed, paying your vendors, paying the rent of your stores, etc. How were you managing that, and what were the measures you took to offset the pain?
There's a lot of concerted effort because you rightly said, as a retailer, almost all our costs are fixed, whether it is rentals or marketing or maintenance or logistics or even employee cost. And the biggest challenge is to make sure that we are able to not just survive, but also, build up, make sure that the organization remains strong enough to, thrive whenever the market reopens. So with that outlook, we have, worked out arrangements with almost all our landlords. We've been very actively in dialogue with all of them. And with the result that we've been able to secure a good amount of concessions on rentals for the lockdown periods and also beyond for most of the properties. On the logistics side also, I think we made a lot of improvements in how we operate, how we were able to send goods to our stores in a more organized manner so that we were able to reduce the number of trips. In terms of maintenance cost also, there is a lot of effort which the store teams have done by themselves to make sure that we are able to save on cost. Obviously, the traveling and the marketing and some of the variable expenses have remained significantly under check. So anything which is discretionary has been put off or deferred. Even on the employee cost, we've made certain policies, we have made certain strictures so that we are able to save on some part of that. And collectively, at an overall level, if you look at the Q1 numbers, I think we were able to shave off cost by almost 40% versus last year. And on a normalized base, that would even look down to, in fact, even more because we had grown since last year. We have had more stores and we have a larger footprint. So thereby, I think in this time of the pandemic, the biggest focus has been to make sure that we remain very lean on cost. And some of these benefits we will like to continue. I'm not saying that these are only limited to the pandemic period, but there are some efficiencies which we have identified which we will like to continue, but not at the cost of growth.
Right, so, and given that you said the focus has been on cost optimization, given that you can maintain this lean structure, how many more quarters could you potentially tolerate this lower volume of business, given that the new structure is not that expensive to you right now? Also, based on the trends that you're seeing, when do you envision a kind of recovery coming in? Do you think it's purely going to be linked to when the lockdown lifts? Or do you think there's also other variables that are now going to play a crucial role in V-Mart's recovery?
No, absolutely. I think as a company, we would definitely not want to curtail our expenditure because the expenditure for us is income for somebody else, and that income leads to consumption for somebody else. So from a company perspective, we definitely do not really want to continue curtailing expenditure. But at the same time, to your first question on our ability to continue operations in this kind of persistent environment, I think from a liquidity perspective, we are fairly comfortable. We've largely remained debt-free all along. In fact, for the last year, March end, we were also debt-free. Only in this quarter, we have probably used roughly around 10 to 15 crores of our working capital limits. And we still have 10 times more limits available for use with us. And so that thereby we do not see a lot of problems, even if the situation were to continue for another year or so. But that is not something that we would want to wish. Coming to the recovery cycle, I think we are increasingly seeing signs of positivity in the markets. Right from May onwards, since the time the stores started to open in a gradual phase, we have seen improvement in the number of footfalls, improvements in the the sales per day, sales per square feet, and almost all of the parameters. So we are in fact internally hoping and estimating that month on month from here on, we should see improvements of roughly 10% versus last year. On an every month basis, and the big festival period is just round the corner. October, November is the big festival period, which also coincides with the the harvesting season and the culmination of monsoons, and then the marriage season. So that is a big period for almost all retailers, and we have some good hopes of good revival coming in from that period. Added to the fact is that we are seeing a relatively better amount of rains and monsoons this year. There's been a record harvesting. There's been a record sowing in the Kharif period also. Going by the trends that we have seen in the last 1 or 2 months since the time these stores have started to open, we are not seeing any dip in the consumption pattern from our customers. So thereby we remain quite optimistic on the recovery cycle, unless something untoward very big happens.
Mr. Agarwal, I just wanted a small clarification from you. Is the company looking at acquisitions in the branded apparel space? We were reading in certain news reports that you are in talks with Arvind to acquire the Unlimited department store. If you could clarify that for our viewers.
Actually, we keep, getting proposals. We keep evaluating them. But as of now, we are definitely not in any acquisition spree. We are not looking at any acquisition. We are not. We may continue to evaluate the markets and the environment to see any good opportunities, but we are definitely not, actively working on any deal. And in any case, at the current moment, with the kind of situation there is, we would rather first want to save what we currently have and maintain that, and then add layers later on.
Right, Mr. Agarwal. Well, thank you so much for taking out to share all those insights with us. It was great chatting with you, and we wish V-Mart and you the best going forward into this year.
Thank you.
That was the management of V-Mart talking about the latest trends. It seemed that the liquidity position is comfortable and that there are signs of recovery, but with that being said, the road ahead remains a challenging one. Let's switch gears a little bit to Titan, which is another counter facing its own challenges today on the back of a not such a strong show in the Q1 numbers and some direct questions from the big bull himself regarding certain hedging policies at that company. But Vinny is going to walk us through the review and what she thinks the numbers fared in relation to what the brokers had estimated.
Titan posted its Q1 FY21 numbers and it's lacking the luster, lacking the shine. The revenues have come in line with ET Now expectations and they're down by 62% and they've come in at 1,862 crores, while the losses have been more than what we were expecting. The losses have come in at 270 crores versus the profit last time of 371 crores. So severe impact on the company's overall business due to COVID-19. Also, this is the first time ever that the company has reported an EBITDA loss, and the EBITDA loss has come in at 246 crores for the quarter. Overall, all the segments have seen a decline. Jewelry business has declined by 56%. This accounts to around 80% of the total revenue. So that's a very major chunk of the revenue which has seen a sharp decline of 56%. While obviously the watches business and the eyewear segment, both of these have also seen a decline of 80% is eyewear business as well as watches business is 90%. So this also has been impacted due to its discretionary nature, plus the stores also being shut. That has impacted the overall business of the company. All in all, the consumer sentiment was quite weak during the quarter. The demand for wedding jewelry was also not there, so that impacted the company because weddings were mostly postponed during this quarter. Plus, the discretionary nature of the company's products like watches, eyewear, even jewelry. Not everyone's going to go and spend much on jewelry unless and until required now. So that is what has overall impacted the business of the company. But in that statement, they did mention that they have made plain gold jewelry sales have been much better than what they were expecting in the month of June, despite the high gold prices. So we are surely going to watch out for that trend in the month of June. And the company, they did say that they are seeing slow gradual recovery, and it's quite an encouraging trend, especially in the jewelry business is what the company is saying, and they expect to recover completely by Q4 FY21 and come back to normalcy is what Titan is expecting. But also let's not forget there's one more thing that has come in the press release, is the sale of a bullion of around 600 crores which is included in the revenue, and this is what they said was mainly due to the reducing their inventory is what was their plan, and that is why they have made this sale. But we'll watch out for the commentary on this specifically from the management in the con call or when they join us on the channel.
All right, Vinny, thanks much for that. Titan continues to be one of the key drags on the Nifty 50 index in the meantime. Slipping into a break, more updates on the other side. Stay tuned. Welcome back. You're still watching Buy Now, Sell Now on ET Now. What did HDFC Mutual Fund buy and sell in the month of July? Let's find out in our ET Now Insight segment. Jayesh is standing by for all the details.
HDFC Mutual Fund now has equity assets more than 1.4 lakh crores, and their top exposure in the month of July stood towards the financials as well as the utility space. In terms of the sector exposure, where they added significant amount of positions, that would be from the financials as well as the industrial space. and the sectors that were not in limelight were the communications as well as the utility space. But interestingly, the top 5 sells and top 5 purchases, those stocks have some trends. Let me highlight those for you as well. The top 5 stock purchases that they had included a lot of index names, the likes of Wipro as well as Tech Mahindra and Sun Pharma, and interestingly the stocks also performed quite well for the month of July. But Yes Bank was the top purchase that they had, more than 16 crore shares that they added to their portfolio, and the stock managed to decline more than 50%. JSPL was the non-index name from the metals basket that they added to their portfolio, more than 50 lakh shares, and the stock also managed to give them double-digit return for the month itself. On the flip side, when it comes to the top 5 sells, once again a lot of index names featuring over here, starting off with big boy Reliance Industries along with BPCL as well as Bharti Infratel. While you had Reliance Industries and BPCL that managed to perform well, Bharti Infratel declined for the month itself. The non-index names actually included the likes of Vodafone Idea as well as PNB, which they have reduced significant positions from their portfolio.
Okay, thanks for that, Jayesh. But in what's also important, PM Modi and CMs of 10 states are going to be meeting to discuss the corona-related situation today. The states are Andhra Pradesh, Karnataka, Tamil Nadu, West Bengal, Maharashtra, Punjab, Bihar, Gujarat, Telangana and Uttar Pradesh. Let's cut across to Nayantara Rai for more on this.
Hi, thanks a lot for that. So as the Prime Minister Narendra Modi chairing a video conferencing today with 10 chief ministers. If you look at the states, these are of course the ones with very high cases of COVID-19. So as India unlocks, as we are almost at August 31st, halfway through to August 31st, of which the unlock guidelines have been announced. Clearly, the Prime Minister wants an update on how the situation has panned out. What's interesting is that we don't know if this is the first such meeting of a series that is going to take place, because what is conspicuous by absence also are the states like Maharashtra or even Delhi, where the Chief Minister Arvind Kejriwal is locked in horns with the mayor of Delhi as far as opening of gyms, malls, restaurants, and all of that goes. It's going to be very important because the Chief Minister's responses, the number of testing that is in place, rapid testing, the recovery rate, and what else can be done to make sure that the economy gets back on track, that more activities become normal. The Chief Ministers are expected to even talk about reopening of educational institutions. Remember, there are mixed reports that have been coming out from China as well as various on whether schools and educational institutions should be opened in places.
Okay, Nayantara, thanks much for those details. Meanwhile, some sweet gains coming in for all the sugar counters. The government is also to hike sugar MSP. Ruchi has all the exclusive details. Let's get across to her. Ruchi.
Well, we're given to understand that the cabinet very soon will be taking up the proposal to hike the FRP, that is the fair and remunerative price for cane, as well as MSP, minimum support price for sugar. This has been a long-standing proposal. We're given to understand that the Food Ministry had sought the interministerial consultations on the same, and now they have moved the proposal forward for the consideration of the cabinet. Well, the proposal is that in terms of the FRP for cane, that will be hiked to 285 rupees per quintal as against the current price of 275 rupees per quintal. This I'm talking with respect to FRP for cane, as well as MSP for sugar, that will now be hiked to 33 rupees per kg as against current 31 rupees per kg. It is an important news story that we're picking up. We're given to understand that the cabinet is going to take up this matter very, very soon, which is likely that perhaps the next cabinet meeting that we may have, this issue will be taken up. We're given to understand, of course, it is coming in at a time when the idea is to ensure that there is a price support that can be given to sugar mills, and which is why the government and sugarcane farmers, which is why the government is going to go ahead with the proposal. It's an important issue that the Food Ministry was looking at, and on the back of it, I think we should mark all the sugar stocks as well, Abba. All of them also seem to be picking up this piece of news that we're putting out.
Okay, thanks for that, Ruchi. Let's switch gears a little bit. And as RBI ups LTV on gold loans, Raj Khosla, founder and MD of mymoneymantra.com, believes at this current juncture it would be a good idea if one opts for a gold loan over a personal loan. Let's listen in to his rationale.
Gold is really glittering. In recent months, the price has risen by 30%. And now that the RBI has permitted a 90% loan-to-value ratio as opposed to the earlier 75%. But mind you, this is only for banks. It's not for NBFCs. It will be a much better option for personal loans because there is hardly any room for assessing the creditworthiness of the borrower. It's the gold in hand that that is assessed, and then you can avail of funds against that. With respect to personal loan, you will have to go through the rigors of being assessed whether you are creditworthy or not, and also the interest rate could be higher than the one that you would get against a gold loan. So it's all in all, a gold loan in the current situation could be a better option as opposed to a personal loan. It will be quicker and it will be less unobtrusive.
Well, that was an interesting excerpt from the Money Show. But if you're unhappy with the falling house rental income, you must tune in to today's episode at 5 p.m. We'll tell you how to earn better rent from your property, the tips to spruce your house and earn a higher income from rentals, coming up on the Money Show at 5 p.m. this evening. With that, we're wrapping it up on Buy Now, Sell Now. Thank you so much for tuning in.